Good morning. Welcome to another Money Monday on the Daily Huddle. As usual, excited to see all of you and got some good things to talk about. If you read the question of the day today, is an annuity right for me? So in that interest, I'll talk about how the financial advisor helped the ladybug by connecting the dots. All right. Well, let's get started today by getting in the right mindset as I look for people that we can talk to and see. All right. What time is it? And what are you grateful for? Andrea.
The time is now, and I'm grateful for time.
For time.
Mm-hmm.
It's a big deal. Where are you and who will you hug today? Chase.
Grand day. Can you hear me?
We can.
I am moving around like a jackrabbit, so I can't be on camera. You said, where am I?
And where are you?
For?
And
I'm
who
here.
will you hug today?
Oh, that's exactly what you said. I'm here, right where I'm supposed to be, with my feet on the Daily Huddle in the present moment. And I will hug a good friend of mine today that is in town from Italy that I haven't seen for 20 years.
Awesome.
Ooh.
Yeah, coming in with his family, so I'm excited to giving him a hug.
Nice. All right. And last but not least, Gio, how are you?
Good morning. Today I am the way I say I am. And today I say I am curious.
All right.
Curious is good.
Curious to see what we have to talk about today. Welcome, those of you coming into the room. For those of you that are joining us on Facebook or watching this podcast after we've done it, today our question of the day is an annuity right for me? And there are a lot of things you read and hear on the internet, and a lot of people that will bring sales presentations if you have one, those kind of things. And our mission is to have informed listeners, informed people that can make their own decisions without having to have other people tell them what to do. So we've got some basics of annuities that we're going to go over today to help you decide if an annuity is right for you. And in that interest, I'm going to turn it over to Kimberly for just a few minutes, and she's got some things to talk about, and we'll go back and forth. We'll share a little bit of a couple of slides, and then we'll have some dialogue.
Good morning, everybody. Well, first of all, I'm Kimberly Otey and my husband, Zack, and we are your hosts this morning on the Daily Huddle. So thank you so much for joining us, whether you're here with us live on Zoom or on Facebook. We appreciate you showing up or even watching us later, right? So thank you so much for that. I'm going to share my screen and just give you guys a little snippet of an annuity. Is an annuity right for me? We hear all of the time, all these different buzzwords in financial services. And I think an annuity is a buzzword, right? Not necessarily a buzzword. It's obviously a product, but it's something a lot of people don't understand. They can be very simple, but they can also be very complicated. So I think it's important to decide if an annuity is right for you. And there are a lot of questions that we bring in when we're talking to our clients about annuities and if it's right for you. So I'm going to share my screen, and then Zack and I can kind of volley back and forth on some of these things. So things to consider when choosing an investment, any investment, right? Whether it's an annuity or anything else, the pieces and the questions to consider when choosing an investment. The first one is risk tolerance. Is an annuity good for you? It depends. Every answer to every question that we're ever going to ask you on air or even in person is it depends. It depends on you. It depends on your risk tolerance, your time horizon, your fee structure, your tax treatment, your liquidity needs, all of those things. The answer is it depends, but we're going to talk you through a couple of these different pieces so you understand some of the things that we think about and some of the things that we talk about. So one of them is risk tolerance. Right now, we know that the market is very volatile, right? We see it in our investment accounts. We see it on the news. We hear the recession word, right? The bad word. We hear that all the time swirling all around us. So our question in risk tolerance is, how does that make you feel? For a lot of people, it makes them feel very, very uneasy, but do they have time and do they have the stomach, right, to handle that volatility and the ups and downs of the market? If they do, maybe that's the right place for them. If they don't, maybe they should consider something that's a little less volatile. Also, time horizon. When do you need to use this money? Is this an immediate conversation? Do you need this money immediately? And if so, do you need it to pay you out systematically, kind of like a pension would? Or do you need that lump sum in your fingertips, in a couple of months or a couple of years? What is that time horizon and how do you see yourself using this money? The next piece is fee structure. So fee structure, what is this costing me? A lot of times in our managed money accounts, you guys know that you're charged based on your assets under management, right? And that's how an investment advisor is going to charge you to invest your funds. Well, annuities are a little bit different, and it depends on the type of annuity that you're talking about. Variable annuities have some fees associated with them. Sometimes fixed index annuities have fees associated with them, but sometimes there are no fees at all. So it depends. What is your fee structure? What is your risk tolerance? And, how much growth and how much risk can you take? And then where do those fees fall into place? Because that's an actual cost to your account as well. And then tax treatment. How do you want this money to be taxed? On annuities, you've got money going in, whether it's pre-tax, like a 401k or an IRA or something like that going in. But you also could have after-tax dollars going straight from your checking account going in, right? And it's going to grow tax deferred, and you don't pay taxes on that money until you access it on the back end. If it was an account that you never paid taxes on before, a pre-tax account like a 401k, you're going to pay taxes on everything. If it was a deposit from your checking account straight into an annuity, you're only going to be taxed on the growth because you were taxed on the initial investment originally. We say annuities are last in, first out. So you're going to be taxed on your growth first before you get your principal back. But it's important to understand all of these pieces. And then finally, Zack, I'll let you clarify too, because I know I'm kind of wordy at the moment. But finally, it's liquidity. How quickly do you need to access this money? So a lot of times with annuities, you've got surrenders, which is why the time horizon is super important when you're talking about investing your money and how quickly do you need it and under what circumstances do you need it? But also liquidity. Do you need 100% of your money back the next day? Or can you handle 5% or 10% or 20% per year? A lot of times your annuities have provisions where you can access some of it, just not all of it during that surrender period of time. So what are those liquidity needs and what does that look like to you? So Zack, I'll let you chat here for a second and then we can go from there.
Okay, just on that note, unmute your microphone. Okay. There's some technical difficulties there. On that note, the biggest thing to answer this question, there's a lot, like I said, out on Google and other search engines, on the internet in general, information about annuities. And for folks that are trying to decide if that's something they should consider or not, you need to be leery of anyone that says absolutely yes or absolutely no, because every single financial product that's on the market has a home. It has a space in the marketplace, or the companies that build them would not invest the time in them and the marketing in them. So the question is, do you know what's right for you? And so that goes all the way back to having some help, but also understanding who you're talking to. If you're talking to someone that represents an insurance company that's selling annuities, they're going to tell you all the reasons that an annuity is the right thing for you. Some of those may or may not be right, and some of them may be overcoming sales objections from market-based liquid brokerage accounts or something like that. If you're talking to an investment advisor that manages 100% of their clients' assets from an assets under management platform, they're going to tell you why an annuity is not the right thing for you. So the real question is, and we teach people this all the time, this is what we want you guys to understand, is nobody cares more about your future and your money than you do. So it's imperative that you are informed. That being said, don't get bogged down in trying to study and research. Just ask questions of experts and understand what angle they may be coming in your direction. So I say that to say things like risk tolerance. Some people might be 25 years old and have a lot of time. So an advisor might say, you know what, you don't need all the protections of a fixed indexed annuity or of a guaranteed account at the bank. But they might be personally someone that gets so stressed out in volatile times in the market that they lose sleep. Well, one of the big things that we talk about here is stress less, right? And take care of yourself. You don't know what the cost on your body is of an increased amount of stress. So that's the things that you've got to look at. Will I sleep better at night if I know I'm not going to lose anything? Or will I sleep better at night if I know I have a potential for gain? So an annuity is simply a tool. So now that we talk about that and you've got these basics of the things that you should look at, we can keep moving on down the line from that. It's a little bit distorted because it's blown up so large, but I don't want you to see talk about types of annuities. Really, the only thing I want you to see are the three colors of lines. The red line would represent what we would call in this scenario a variable annuity, where you are in a contract with an insurance company, which is all an annuity is a contract between an individual and an insurance company to get a certain amount of payout over a certain amount of time. In the red line, which is variable, like Kimberly mentioned before, there's probably going to be some internal fees associated with that account. But the upside of a variable annuity is that you get to participate in all of the ups of the market. So when it comes to the market going crazy and going up, then you get to participate in all of that. The downside you'll see also is you get to participate in 100% of the drops in the market. So that's the red line again. At the opposite end of the spectrum from that risk tolerance or from that person is the blue line that you see that's straight and level. And that would be what we would just call a fixed account. You're going to get guaranteed fixed rate of return, somewhat CD-like, but in this case, we're talking about an annuity where you're going to get a guaranteed rate of return over time. And that's why that line is very consistent with zero volatility. It's going to be the least potential for growth, but it's going to be also the one consistent where you're always going to gain something. I will contrast that to the green line. So the blue line and the green line have one thing in common. The green line is what we call an equity indexed annuity. And the green line right there, if you see that, has ups when the red line goes up, but when the red line goes down, it stays flat. So whereas the blue line, you're guaranteed against loss, and the green line, you're also guaranteed against loss. In the blue line, you're guaranteed to get something every year. In the green line, when the market goes down, you get zero. So there is that difference between those two. So really what you're looking at here, and this is what you want to find out, is first, does the platform of an annuity work for me? If I put my money in here, am I going to need lump sums of it in a certain amount of time? There are different rules for different ones. So you want to make sure you ask all those parameters of how the annuity works. Is this money, can I afford on a daily basis to be worried about what the news says? Mentally and physically, can I handle riding that roller coaster? That's one part of it. And second, on time horizon, can I handle a drop at this stage of my investment life? Those are things that you've got to look at. That's one of the big problems that 401ks are having as the number one retirement savings vehicle, is that they work if the market performs and behaves the way you need it to. So that's what that piece of time horizon is that Kimberly talked about. And then, so lastly, we'll kind of conclude with this comparison about the types of annuities by saying, I hope that that sheds a little bit of light on the fact that when someone says, stay away from annuities, they're bad, they have an experience that goes along with that. They have context to that, right? Where most people do. The same way if you're talking to an advisor that has a particular product that they're offering, there's context for their offering. So I talk to my kids a lot about seeing where people are coming from, right? There's a lot in our media or in the world right now where people are very offended by different things, and people don't understand each other. And the reason that is a lot is that they don't look and see where they're coming from. They assume that because we're in the same room, that we're coming from the same place. And so that same thing can apply when you're listening to advice when it comes to finance, when you're listening to advice when it comes to how to treat others, or when you're reacting to someone's comments about investment advice or about something that you may see from a different angle. So that's what I want to share with you guys about annuities. And Kimberly's got some points about how to treat them and how to use them, and some of the psychological things that we deal with as employees, investors, and then retirees. So Kimberly, why don't you shed some light on that?
Thanks. So again, annuities are complex. There's a million different types, a million different insurance companies. So you have to understand what your purpose of it is and why you would use it. Why do I like annuities? I love annuities to create a pension. So for people that are close to retirement age and they have that money, and if they're in the current 401k, they have to retire first, right? Because you can't typically do something with money when someone's still employed with that same employer. But when they're ready to retire, I love using annuities for a pension. Why? Because we work our entire lives and we get paid every 2 weeks, right? Every 2 weeks or once a month, we get a paycheck coming in. And when we retire, those paychecks go away. So our job during retirement is to learn how to manage our assets, that all we've done is focus on growing and accumulating during our entire working years. For the last potentially 30 years, right? I've been paid every 2 weeks. So when I retire, the natural tendency, because it has been trying to accumulate all that money, is to not touch it. Right? But you have to touch it. And then so it becomes, how do I do this? I think annuities are perfect in that example because it's going to give you that guaranteed paycheck for the rest of your life, as long as it's structured properly, right? So having that paycheck come in every 2 weeks, once a month, once a year, however you structure that distribution to you, I think is a great piece. I don't think it's your only piece in retirement, but I think it is a great option to use to guarantee that income. There's a guy that does a lot of training in the financial services and insurance world. His name's Tom Hegna, and he wrote a book called Paychecks and Playchecks. And basically what he says is that you need to guarantee your paychecks with something like a fixed indexed annuity. You're guaranteed never to lose. As long as it's structured properly, you're guaranteed to have your income coming in every single, month, week, however you structure it, for the rest of your life. And you know that at minimum, your bases are covered. That's a big deal. It's a huge peace of mind. I think for seniors, their biggest concern is outliving their income. And then you take the difference of what you have that doesn't have to, go towards those basic needs. And then that's your paycheck money, right? That's the money that you invest however you want to, and you can take a little more risk with it and you can allow it to grow. So I think, again, the question is an annuity right for me? It always depends, but I think that's a perfect example of how that works. Also, let's talk about surrenders for a minute. So typically annuities, regardless of whatever annuity you're choosing, has a surrender period, ranging anywhere from 7 to 10 to sometimes 14 years on a surrender. Does that matter? Are you worried about that surrender? It depends, right? if you're truly setting your money up for a pension and you're truly setting your money up for an income stream, you're not looking at that lump sum as something to pull out. You're looking at that lump sum that you're putting in to guarantee that you're going to have a paycheck for the rest of your life. In that example, to me, I'm not worried about the surrender period because my goal isn't to reach in and lump sum it back out. But if that is your goal and you just want that safety and security of an annuity because you don't want the volatility of the market, and obviously a variable annuity is a little different, but you don't want the volatility of a market either in a fixed annuity or a fixed indexed annuity, then you have to make sure if you need that lump sum that your time horizon meets that surrender period. So lots of different conversations there. I'm sure all of you guys have heard bits and pieces of annuities. I do think that they're amazing. As long as they're used properly. And I think putting them in place for something like a pension to guarantee our income for the rest of our lives, especially at our retirement age where we don't have time to overcome a recession or something like that. I think it's a great tool to have in your bucket and to pull it out and to use it to guarantee that income stream. Anything else you want to say, Zach, before we open it up for comments?
No, I'd love to hear if anybody has any of those stories or that history with something where somebody said absolutely not or stay away. Not because I want to overcome objections, but because I think it's always interesting to hear. And then maybe somebody has a positive story about them. We have many positive and negative stories that we've heard over our career about annuities. And beyond that, just questions if you have something. I see Ronald's hands up.
Hey, Zack and Kim, how you guys doing?
Good, how are you?
Good, good. I'm trying to get, I guess it's terminology for me. You got index universal life insurance annuities. Is that two different product or is it the same product?
So there is a common denominator, which is the index word that you hear. So an indexed universal life is a life insurance product. And it is
life insurance policy.
Yeah. So it's designed to pay a monthly premium and receive a death benefit on the back end at its core. An annuity is different than that. It is a contract with an insurance company where you're putting in your money with the insurance company. And a lot of times they're single premium. So you put a lump sum in there into an annuity and you take it out over time. You're not buying an extra death benefit. In a lot of cases.
So yes, two different products.
You're taking it out over time? Is that what you said?
It depends. You can lump sum it out or you can take it out over time, but they're definitely two different products. An indexed universal life insurance policy, you have to qualify medically for, you have to be able to afford it, has to make sense. And an annuity is different. It's still, both are still governed in that life insurance space, right? Through those life insurance agency rules, but two different products that fill two different needs, if that makes sense.
Yeah, it does. So in other words, having both is a good thing.
Can be.
As long as, absolutely, that they serve two different purposes. Having both can be a great thing and I would tell you from an index universal life perspective, I love those as well. We sell them quite a bit, but it depends on your health and your age and can you afford to fund it? If you can't, that's not the right policy for you. Does that make sense? So
Yeah.
Everything in this world, unfortunately, depends. And so that's where, I don't know if you guys were on when our friend Freddie came and talked about, buying a car and how to buy a car. The way you buy a car is to be the most educated and to research and ask your questions. And in this world, it is too. Definitely find an advisor that you trust, and then ask those questions through the knowledge and the conversations that you've heard, and they can help you through those decisions.
So quickly, how much can you ask you start an annuities with? How much money?
It's going to depend. It's going to depend on the company. It's going to depend on the purpose of that product. Some of them you can start for as low as like $2,000 or $2,500. Some of them have minimums of $20,000, $30,000, $75,000. It totally depends. So that's where you want to sit down with an advisor and you want to say, I have this much money. What do I do with it? And then that advisor should be able to say, here are your options. Let's talk through them. So if this were you and I, and you said, I had $20,000, Kimberly, what do I do with it? then I would say you have these choices with this money, whether it's the managed money account, the indexed annuity, fixed annuity, variable annuity, whatever those are. But we would talk about them in big general terms. And you would talk, this is the one I think I like the most. Then we do a deep dive into that product and that conversation. So it's always going to depend. But some of them allow you to start very small. The one caution I will tell you is if you choose to do an annuity that's not just a lump sum where you just dump it in and set it and forget it and let it do its thing. If you do that annuity with, a small contribution, then add to that as you go. Double check. Some annuities allow you to do that without changing your surrenders every time. Other annuities have a new surrender on every deposit. So sometimes I don't like it for that reason. It depends on the annuity. So anyway, lots of things to think about and lots of questions and conversations, but it's important to have somebody you trust that can guide you through that process. What other questions do we have? Sorrel?
So the thing I'm getting is that you can use an annuity to replace your paycheck.
Absolutely.
So the amount you would start with would depend on the amount of money you want your paycheck to be.
Absolutely. And the amount of money you have, to start with, right? That you have access to.
Yeah. So it doesn't work like magic where you could put whatever in and get the paycheck you want. You actually have to have the lump sum to start with that would give you that paycheck.
Or the time, but it's a mathematical equation, right? And a lot of times, like if you put money, let's say that I'm retiring tomorrow, and I have $300,000 in my 401k and I dump it in there. Then if I start taking that money immediately, the illustrations that we run our annuities based off of is going to tell you how much you can receive. And if you can receive it, conceptually, if you just divided it by 10, you could get 30,000 a year over the next 10 years, and then you're done. You're out of money. So what can I get and guarantee it forever? That's what the illustrations inside the insurance company are going to show you that they can do. But if you dump that money in today and you don't need it for 10 years, your income in 10 years is more than your income today. And those illustrations will show you all of those different variables. So for some people, it might not be a retirement conversation. It might be, I left my job, I have a sizable amount in this account, I'm starting a new job, but I want to set this up for that paycheck later down the road. And they still have time of working. All depends on their place. But yes, people setting it up for a paycheck is a big deal. But depending on how much you put in, depends on how big your paycheck is going to be.
Thank you.
You're welcome. Any other questions before we head out this morning? Comments? I've heard in the past, and if you guys have some, you can interrupt me, but I've heard in the past, people say, I don't like annuities and, I can lose money in annuities. Well, again, annuity is a big term for a lot of different policies and a lot of different products. So understand what people are talking about, where they're coming from, like Zack said. But annuities also used to have mandatory annuitization, meaning you put it all in and you had to take it out over a certain period of time. Now, annuitization, which is that paycheck conversation, is an option, but it's not a requirement. So you don't necessarily have to annuitize that money. You can use it for that stopgap. And you also in the past had annuities that you would put your money in and it would guarantee you a certain payout over a certain period of time. But if you got hit by a bus tomorrow, your money was gone, right? So all of these things have changed for the better through the years. So if you have objections or hear people talking about objections to annuities, understand what they're talking about because it probably doesn't apply today. It's probably old information. Ronald, one last thing before we head out.
Yeah. Can you transfer a 401k to an annuity?
Yes, you can. You can roll it over and you can do that without a taxable event, as long as you don't take possession of it and go from there. You absolutely can.
Work for that company.
Or currently work for that company. Usually there are provisions if you work for the company currently that you can't move that money unless you're like 55, and there's a few pieces, but most of the time you can't move your 401k if you're currently employed with that same employer, but you absolutely can. So, all right. Well, thank you guys for everything. Zack, do you have the 8 tenets pulled up?
I do.
Awesome. I will let you share our 8 tenets and wrap it up for this Monday.
Well, guys, remember, like we sign off every time, remember to love, laugh out loud, stress less about money and about other things. Eat mostly plant-based, take care of your body, give, sleep, it's important, move, and finally check yourself before you wreck yourself. Guys, it's been a great day. I hope we gave you some good information. Again, we'll see you next time here on the Daily Huddle.
Bye, guys.
Thank you.
Enjoy your week. Absolutely. Thank you. Thanks for joining.
Welcome, Taylor.